So I'm going to spend my time talking about why I think that disaster insurance is a critical part of recovery, why despite that fact, too few people actually have disaster insurance, and then end with 4 ideas on how the public sector and the private sector can work together to start overcoming the challenges and harnessing the benefits that disaster insurance has to offer us. I think this is an increasingly urgent task as disaster losses continue to escalate. This is due to the combined forces of continued development and often inappropriate development in risky locations, as well as climate changes that are altering the frequency, the severity, the timing, the duration, the spatial extent of many weather-related events around the world. So these 2 forces are driving up losses for different perils and in different places. And so in the face of this escalating risk, I want to spend some time talking about why I think disaster insurance has to be an important part of the conversation. There's now a growing body of research that those with insurance recover better and recover faster than those without insurance. And the reason for this is simple. Insurance tends to provide more funds and provide those dollars faster than almost any other form of post-disaster assistance. So let's unpack that a little bit. Very affluent households can tend to cover the costs of rebuilding, repairs, reconstruction with their savings, but that's not the case for the majority of Americans. Indeed, 44% of Americans do not have $400 in liquid funds for an emergency. And if you don't have $400 for an emergency, you certainly don't have enough funding to cover the costs of a very severe disaster event. So if you don't have money in the bank to cover your losses, then what? Well, the first form of financial protection, as it were, after a disaster event is actually a loan. These could be obtained from a private lender, but the federal government provides disaster loans through the Small Business Administration. These loans are a really important part of recovery for a number of households, but access to credit is not a panacea. And often for some of the families that need assistance the most, loans aren't an option because taking on additional debt is burdensome or not possible. Work by a colleague of mine has found that over half of applications to the SBA disaster loan program are rejected because the applicant is uncreditworthy. So these tend to be the low-income families that don't have debt-to-income ratios or credit scores that will qualify them for loans. So if credit after the fact isn't going to do it, then what? Well, there persists a misperception that federal disaster aid will make victims whole, and this is actually not the case. So for federal resources to be made available after a disaster, it tends to require a presidential disaster declaration. The majority of those historically have not authorized the program that provides grants to individuals. When that program is activated and FEMA makes grants through the Individual Assistance Program, those grants are only to make homes safe and habitable again. They are not designed to bring people back to pre-disaster conditions. And you can see this by looking at the average amounts. So after Hurricane Harvey, the average individual assistance grant was only $4,300, but the average flood insurance payment was $115,000. So while individual assistance is important, it is not going to help people get back on their feet when they've experienced a very severe disaster event. For those of you that follow disaster aid, I should also note, you might be wondering what about the dollars that go to the Department of Housing and Urban Development, because Congress appropriates large sums to their programs often after large disasters. Those programs can again be important, but states and local governments have enormous flexibility in how they use those dollars, and they may or may not set up programs to help reimburse families for the cost of damage to their home and their contents. And even when they do, it is months and more typically years between when the disaster occurs and when the household would see those dollars. So again, it's not a source for immediate recovery for most families. So this is all just to say that there really is no substitute for disaster insurance in terms of getting people back on their feet. And yet, despite that, lots of people don't have the coverage that they need. And this isn't just a problem in the US, it's a global problem. Swiss Re estimates that 70% of disaster losses are uninsured. In the United States, part of the challenge stems from the fact that when you take out a typical homeowner's insurance policy, it tends not to include a number of disasters. So it doesn't include flooding, it doesn't include earthquakes. Homeowners have to know to purchase a separate policy for those losses. And as we'll see, they tend not to. So let's look at flooding. After lots of flood events, we often find that those victims don't have the flood insurance they need to recover. So if you look at the second bar there, after Hurricane Sandy, New York City estimated that 20% of those that sustained flooding had flood insurance. The next one shows some Baton Rouge that suffered terrible rainfall-related flooding in 2016. They estimated that 12% of victims had flood insurance. Going into Hurricane Harvey, about 15% of households in Harris County had flood insurance, and going into Irma, less than 1% of homes on Puerto Rico had flood insurance. So you can see there's a large flood insurance gap that persists in the US. But it's not just flooding. If you look at earthquakes in California, roughly 11% of residences in California have earthquake coverage, so we have a large earthquake gap as well. While other perils tend to be more widely insured because they are in homeowners, there's challenges in those markets as well. So California right now is concerned at seeing some pullback in some of the most wildfire-prone areas among insurance companies after the devastating fires in 2017 and 2018, and predictions that those types of fire seasons are just going to become more common or get more severe. And if you look at, say, homeowners policies, in places where hurricanes are common, those policies tend to have a hurricane deductible, which means that households bear a much larger share of the losses if the damage is from a hurricane than from another peril. Now, those types of limitations on coverage are actually really critical to letting insurance companies write the policies in the first place at a price that people can afford. But they do create real holes in consumers' financial protection. But I think with the right policies between the public and private sector, we can start to make sure that everyone has the resources they need. So before we jump into some possible policies that might help solve this challenge, we need to talk a little bit more about why this insurance gap exists in the first place. And there's a number of reasons. Let's start with some demand-side challenges. The first is lack of information. So many households don't have good information on the hazards to which they're exposed at the time they need it most, like when they're deciding where to live. Most states have hazard disclosure laws, but these laws tend to either be insufficient or, at worst, actually misleading about disaster risks. They also tend to focus on probability. So are you in a 1% annual chance floodplain? And say nothing about potential consequences. Does that mean I'm going to get an inch of water in my basement? Does that mean 10 feet of storm surge are going to come at my house? Does that mean I'm going to have $1,000 of damage, $10,000, $100,000? Understanding that range of potential consequences and the likelihood of those different consequences is absolutely critical to making decisions about risk reduction as well as insurance. We also have no programs in place to talk about how risk is changing over time. And as we've already talked about, we know for a number of perils, the risk is just getting worse. And we're not communicating effectively when people and communities are making decisions that will persist, like where are we going to live, where are we going to develop, where are we going to site infrastructure, not what's the risk today, but what's the risk in 5 years, 10 years, 50 years over the life of those investments. We've also found that insurance is a very unintuitive product for most people. Insurance is a tool to smooth income. It's a risk management tool. We've found consumers who think they can pay a small premium after a disaster has occurred to get the large claim payments to rebuild on the loss they've already sustained. Of course, insurance doesn't work that way. We've seen consumers who think that insurance is like an investment. And so if they're not getting regular returns in the forms of regular claims payments, it's not worth it, and they drop their policy. So if consumers don't understand how insurance works and the role it plays in their finances, they're often not going to think it's worth paying for. Then I just want to say that there is a large and growing literature in behavioral economics and cognitive psychology that tends to point to the fact that people are poor decision makers when it comes to risk. We're overly optimistic, we dismiss low probabilities, and all of that applies in the context of insurance as well. And then finally, disaster insurance can simply be too expensive sometimes, and families can't afford it, or they don't think it's worth it. I want to spend a little bit more time on this issue of price because it gets into some of the supply side challenges with disaster insurance as well. So disaster insurance tends to cost more than other lines of business. So think about auto insurance. When I get into a car accident, it doesn't make it more likely that all my neighbors have also gotten into a car accident. And every year, some people are in crashes, and insurance companies are paying those claims, but those losses are more or less stable from year to year. And that's not the case with disasters, right? Because when I suffer a disaster loss, it's quite likely that everyone in my community is also suffering losses. So what you get is this kind of spiky loss profile, which you can see here in losses from the flood insurance program by year. There's a number of kind of quiet, good years, and then you'll see these extraordinary loss years. And in order to pay claims in the extraordinary loss year and not go bankrupt, an insurance company has to have access to a lot of capital sometimes. And in order to have access to that capital, they'll do things like purchase reinsurance, securitize the risk in the financial markets, build up reserves, all of those things that were costly, and those costs have to be passed back on to the consumer, making the disaster insurance, again, more expensive than other lines. And consumers sometimes don't understand or appreciate this need. So what you can get is a breakdown in disaster insurance markets when there might not be a price where the disaster insurance can be profitably offered and consumers are able or willing to pay that price. And when we see this breakdown in insurance markets, governments have intervened in these markets in a number of ways. And in fact, there's almost nowhere in the world where there's a fully robust private disaster insurance market with a large take-up rate absent government intervention. These interventions take a number of different forms. So sometimes these are public or sort of fully public or public-private partnerships that write the coverage directly to the consumer. That's what we do here in the National Flood Insurance Program. That's how the Earthquake Authority works in California. That's how most of the wind pools along the Gulf and Southeast states work as well. Another structure, though, is for the federal government to be a backstop or a reinsurer to the insurance companies that then write the coverage directly to the consumer. That's how we handle terrorism in this country, and it's how a number of other countries around the world handle all of their natural catastrophes. These programs also differ along other dimensions as well, such as, is the insurance voluntary or is it mandatory? How are prices set? What are the incentives, if any, for risk reduction? So you can see the challenge really becomes, how do we design these programs to allow the private sector to operate in the range where it can, provide proper incentives for risk reduction and development, equitably distribute the cost of disasters, and make sure that everyone has the financial resources they need to recover. And that's a tricky question. And the challenge is that there's not one silver bullet solution. There's not just one thing we can do and solve this. What we have to do is adopt a number of different policies all working together. So in my last few minutes, let me turn now to 4 policy suggestions on how we can start making headway on this problem. The first is addressing affordability. As we've talked about, oftentimes the people who need insurance the most are the least able to afford it. This issue has gotten a lot of attention when it comes to flood insurance, and there's now been research by a number of scholars, by the National Academy of Sciences, by FEMA. All these reports tend to coalesce around the idea of means-tested assistance to help low-income families afford the cost of flood insurance, or you could, to afford the cost of any disaster insurance more broadly. That would require Congress to set up such a program, and so far they have not chosen to do so. Absent such a federal program, a few local governments around the country are actually starting to develop their own programs to help their residents with the cost of insurance. We've done some work recently with the city of Portland, Oregon, for example, and they set up a very innovative pilot program in a couple neighborhoods in their city that helped those households navigate some of the complexities of the flood insurance program. The details, for those of you who are interested, are in a report on our website. But the way they set this up helped those households realize real substantial reductions on their flood insurance costs. Pilot programs like this one can point the way to how we could have more states and local governments helping in this space, but it probably could never replace what a universal federal program would do. Second, it's the case that insurance is harder to provide and costs more when the risk is higher. And because of this, we really need to think of investments in risk reduction as complements to insurance, and we need both. And investing more in risk reduction absolutely has to be a partnership between the public and private sectors. Local governments, for example, need to adopt stronger building codes that have been shown in research to be cost effective and do more to limit development in some of the riskiest areas with an eye to how that risk is changing over the life of the investments that they're allowing. The federal government needs to work to undo some of the perverse incentives that exist to continue to develop in ways that are too risky and shift more of our mitigation dollars from a post-disaster to a pre-disaster context. Now, this is already starting to happen, and it's important because while it is absolutely critical to have dollars for mitigation in rebuilding, It can also be hard for communities to set up standing programs and spend that money wisely, and it makes it difficult to target federal dollars at the communities that need the assistance the most, at the places that are most risky, or on the investments that have the largest payoff. And with limited federal resources, it's important that we do a better job targeting those dollars. And then, of course, the private sector needs to do more to actually fund risk reduction, also set up financing. And then I also think there's a role for the private and nonprofit groups in helping smooth and eliminate some of the transaction costs to investments in risk reduction, which are real and actually limit the amount that's done, particularly at a household level. So I'm talking about things like, how do I even know what risk reduction investments I should adopt for my home? And even once I have a sense of those, how do I find a contractor who can do the work that I trust, that I know is charging me a fair amount? And if there's multiple options, how do I prioritize them? Those types of questions are difficult for households to answer, and they often stop people from pursuing the projects in the first place. As we talked about, we also need to do more to improve understanding about risk at the time it matters most, when people are making the decisions like where to live. And I actually think we are very close to solving this as a society. There's been some great work by private sector groups and nonprofits on collecting hazard information and making it presentable to people in the platforms they're already using. So I'm hopeful that we're close on this, and there's a large body of research on how to present risk information in a way that motivates behavior change that can guide these efforts. There's also been some good work by groups on improving insurance literacy. And that needs to be done, again, most importantly, at the time when it matters, when people are choosing their insurance coverages. And there's a number of people that consumers often interact with in making those decisions who need to be educated and empowered to help consumers do that better. Insurance agents, realtors. We've found in some of our research that insurance agents, for example, who don't work with the flood insurance program a lot, often are ill-equipped to provide good guidance to consumers on those policies. And so Oregon and other states, for example, have started to adopt continuing education requirements to make sure that those agents have all the information they need to be helpful. And then I just want to end by saying that disaster insurance is most effective when it's part of a broad culture of disaster risk management. So what we've been thinking about is how all these pieces fit together. So for the financing, you need a layer cake approach. There's a deductible that would vary based on the household's ability to pay. And then they'd have an insurance policy that should cover all the natural hazards to which they're exposed. Of course, some of that risk is then going to be put in the private reinsurance markets and the financial markets. And then you can have a federal backstop at the very top. Because when it comes to catastrophic losses, the private sector is not going to be able to effectively offer those policies unless they can kind of have that severe tail cut off so that they know that they're not going to be bankrupt by providing this type of coverage. And then that layer cake of financing can be supported by the risk reduction and risk information and communication measures that we've been talking about. And I think if we do that, put all those pieces together, then we will have really made headway on making sure that households and communities are resilient in the face of the increasing disasters that we now face. So thank you. That's a good question, and it's tricky because getting private sector data on insurance coverage is very hard. That's not something you can just go online and look up. So we do have a public flood insurance program, so you're right, there could be partnerships with the NFIP to help communities with that. But I think it's more about making sure that part of the education and the dialogue in communities about preparedness includes financial preparedness as well. And so hoping that consumers understand, that flood's not in their homeowner's policy, that they need it, that they need to be updating their insurance coverage over time as well. We've seen after the wildfires, for example, that some people were underinsured, so they didn't have enough coverage that was sufficient for rebuilding. So there's a number of dimensions on that. That is a really good question, and it gets to this real difficulty with writing catastrophe insurance in the first place. So I think a point to drive this home is that after the Northridge earthquake, insurers paid out more in earthquake claims than they had ever collected in earthquake premiums over their entire history of operating in the state. And so these losses can just be devastating. So there's a number of different policy solutions that have been considered. So for example, you could think about the federal assistance, for example, like the individual assistance grants coming in and covering those deductible expenses, and then insurance starting where it can. So if you can effectively layer the coverage, that's helpful. It's also the case when it comes to earthquakes. This is an area I don't know much about, but I've heard from engineers that what makes the most sense is first taking your dollars and bracing and bolting your home. And that can do a lot to lower losses, make the insurance coverage cheaper, and help protect the consumer. But it's really about, putting all these pieces together. I think certainly where I am, there's an interest in making sure that research is made available to policymakers when they need it. And I think this gets to a trickier question of how academia engages with the public sector. Often questions that are of interest to academics are not the questions that are of interest to decision makers. So sometimes there's a real disconnect between the research that would be interesting and support academic careers and what would help public policymakers. That requires a lot more dialogue between researchers and policymakers, and sort of co-creating not just the research, but the questions in the first place. It also means establishing relationships, right? So that people know, if an academic has done some interesting research, knowing who to even present that information to. And when a decision maker has a question, that they know who to go to get some of the answers. So I think a lot of it comes down to more collaboration. I'm not aware of much being done yet, but it's certainly an important topic of conversation. And I think what is still being worked out is what is the best way to make sure that low-income families have the coverage they need. So is it assisting them with the costs of insurance? Is it altering our federal disaster aid programs so that the disaster aid is actually better targeted and provides sufficient amounts to low-income families? Is it actually thinking how the private sector can step in? So we're doing some new work now on the role of micro-parametric insurance products that have been used in the developing world to help low-income families get coverage right away, to get assistance right away after a disaster. Can we have that apply in the US context as well? So I think there's a number of promising approaches, and which one is going to really be the one that works effectively here, I think is not quite clear yet, but we need to start pushing on it.